Tonight, you're going to check your bank balance before you fall asleep. Just a glance, a habit, a small flicker of anxiety you don't even notice anymore. Maybe you tell yourself it's just to make sure a bill cleared or to see if a paycheck landed. But if you're honest, the flicker isn't really about the number, it's about whether the number can be trusted at all. That flicker has a history. It didn't come from nowhere. It was built, crisis by crisis, over the last 100 years, by decisions made in rooms you were never in, by people whose names you were never taught. Tonight, you're going to meet the crises that built it. Here's the pattern. Every financial crisis follows roughly the same shape. Something gets set up, something triggers it, everything collapses. Someone responds, the rules change, and somewhere, quietly, you end up carrying a piece of it forward, even decades later, without knowing why. Let's start in 1929. The setup was optimism, pure, uncomplicated optimism. Stock prices had been climbing for years, and ordinary people, not just bankers, started buying shares on margin, meaning they were borrowing money just to buy stock they hoped would keep rising. Debt on top of hope. Shoeshine boys were reportedly giving out stock tips. Nobody thought the climb would ever stop. The trigger came in October, specifically October 24th, a day now remembered as Black Thursday, followed days later by an even sharper drop on October 29th, Black Tuesday. The market didn't just dip, it buckled, wiping out roughly a decade of gains in a matter of days. The collapse that followed wasn't a single afternoon, it was years. By 1933, U.S. unemployment had climbed above 24%. 1 in 4 people who wanted work couldn't find it. Banks failed by the thousands, roughly 9,000 of them over the course of the decade. And when a bank failed back then, your money simply vanished with it. There was no safety net catching it. People who had done everything right, saved carefully, worked hard, watched their entire life savings disappear because the bank down the street ran out of cash. The response came slowly under President Franklin Roosevelt. A new agency, the Federal Deposit Insurance Corporation, was created in 1933 specifically so that if your bank collapsed, your money wouldn't collapse with it. The rules that changed were significant. Banks were now required to insure deposits. Regulations separated risky investment banking from ordinary consumer banking under a law called Glass-Steagall. And what do you still feel today? That quiet reflex, checking that your bank is FDIC insured before you trust it with your paycheck. You didn't invent that instinct. It was handed to you by people who watched their savings disappear overnight. Now let's jump to the 1970s. The setup this time was a currency system under strain, something you may have already learned about elsewhere, but layered on top of it came a second shock. In 1973, an oil embargo led by OPEC nations quadrupled the price of oil almost overnight. The trigger was that price spike, hitting an economy that was already fragile from years of heavy government spending, and a currency no longer anchored to gold. The collapse looked strange, almost contradictory. Normally, rising prices come with a booming economy, businesses hiring, wages climbing. Instead, prices rose while growth stalled, and unemployment climbed at the same time. A combination the economic textbooks of the era said shouldn't even be possible. Economists needed an entirely new word for it: stagflation. Gas lines stretched around blocks. Grocery prices climbed month after month with no relief in sight. The response, under the Federal Reserve Chairman Paul Volcker starting in 1979, was brutal but deliberate. Volcker raised interest rates dramatically, at one point above 19%, deliberately slowing the economy to choke inflation out of the system. It worked, but it came at a cost. Unemployment climbed past 10% before inflation finally broke. The rules that changed centered on the Federal Reserve's role itself. Central banks afterward treated inflation control as their primary job, sometimes above almost everything else. What do you still feel today? Every time interest rates rise and your mortgage or credit card payment climbs with it, you're feeling Volcker's decision, still shaping monetary policy 50 years later, now 2008. The setup was mortgages, specifically mortgages given to people who, under any earlier standard, wouldn't have qualified for them. Lenders called these subprime loans. These loans were bundled together, sliced into complex financial products with names like mortgage-backed securities and collateralized debt obligations, and sold as safe investments, often carrying top-tier credit ratings when many were anything but. The trigger was simple in hindsight. Housing prices, which everyone assumed would keep rising forever, started falling in 2006 and 2007. Homeowners began defaulting, especially those with adjustable rate loans whose payments suddenly jumped. The bundled products that were supposedly safe turned out to be built on sand, and almost nobody in the financial system had priced in the possibility that home prices could fall nationwide at once. The collapse spread with terrifying speed. Lehman Brothers, a 158-year-old investment bank, filed for the largest bankruptcy in U.S. history in September of 2008, with over $600 billion in assets. Credit markets froze worldwide. Banks stopped trusting each other enough to lend overnight cash, something they do routinely and had never stopped doing before. Unemployment in the U.S. climbed past 10%. Millions lost their homes, and global stock markets lost trillions of dollars in value within months. The response was massive and immediate. Governments and central banks poured trillions of dollars into propping up the financial system, a program in the U.S. called the Troubled Asset Relief Program, alongside years of a policy called quantitative easing, essentially creating new money to stabilize markets. The rules that changed included the Dodd-Frank Act of 2010, requiring banks to hold more capital in reserve and imposing stress tests, essentially simulated crises, to check whether banks could survive a real one. What do you still feel today? If you've ever heard the phrase too big to fail, or wondered why your bank now asks for so much documentation just to approve a loan, the caution was born in 2008. One more, because it's recent enough that you likely remember living through it. 2020. The setup wasn't financial at all at first, it was a virus. But the response to that virus, lockdowns, shut businesses, halted travel, hit the economy like almost nothing before it. The trigger came in March, when markets realized the shutdowns weren't going to be brief. In a matter of weeks, U.S. stock markets fell roughly a third of their value, one of the fastest collapses in history, faster even than 1929. The collapse this time was oddly split. Unemployment spiked instantly. Over 20 million Americans lost jobs in a single month. But unlike previous crises, governments responded almost immediately, not months later. The response was enormous and fast. Trillions of dollars in stimulus payments went directly to households and businesses. Central banks slashed interest rates to near zero and bought assets at a scale even larger than 2008. The rules that changed were less about new regulations and more about precedent. Direct payments to citizens, once considered radical, became a tool governments reached for again during the crisis. And the idea that central banks could intervene at nearly unlimited scale became normalized in a way it hadn't been before. What do you still feel today? The inflation that followed in 2021 and 2022, prices for everything from groceries to used cars climbing sharply, was in part the delayed bill for how much money was created and distributed so quickly. If your grocery bill still feels higher than it should, you're feeling 2020's response, still working its way through the system years later. Notice something across all four of these stories. The setup always looks like confidence, or in one case, an emergency nobody saw coming. The trigger always looks small in the moment it happens, or moves faster than anyone thought possible. The collapse always spreads faster than anyone expects, and the rules that change afterward are always a direct response to whatever broke, patched reactively, rather than designed in advance. This is the strange rhythm of financial history. Systems are built to prevent the last crisis, almost never the next one. The FDIC prevented bank runs. It didn't prevent stagflation. Volcker's rate hikes tamed inflation. They didn't prevent mortgage-backed securities from quietly poisoning the system decades later. Dodd-Frank tightened banks. It didn't prevent a global shutdown from requiring the largest stimulus response in history. Nobody knows yet what the next crisis will exploit instead. And here's the part that connects all of it directly to you, tonight, checking that balance before bed. Every rule sitting quietly underneath your financial life right now, insured deposits, interest rate policy, bank capital requirements, exists because of a crisis you likely never studied, involving people you've never heard of, making decisions under pressure you'll never fully understand. You didn't choose any of these rules, you inherited them. The way you think about risk, the reflexive comfort of a federally insured bank, the flinch when interest rates rise, the vague unease every time markets get volatile, the quiet suspicion whenever a government announces a new spending program, all of it was shaped by 1929, by 1973, by 2008, by 2020, layered on top of each other like sediment, each one adding another rule, another reflex, another small piece of caution you now carry without ever having chosen to. So tonight, when you check that balance and feel that small flicker before you sleep, here's what's actually happening underneath it. You are not anxious for no reason. You are carrying the accumulated caution of a century of collapses, inherited quietly, passed down not through conversation, but through the very structure of the system you live inside, the forms your bank makes you sign, the insurance sticker on its door, the way the news reacts every time a central bank makes an announcement. The crises ended. The rules they left behind did not. They're still running right now in the background of your life, in ways so ordinary you've stopped noticing them entirely, quietly shaping how much you trust a bank, how you react to rising prices, how nervous you get when the news mentions a recession. Tonight, you'll check your bank balance before you fall asleep. Just a glance, a habit. But now you know where that flicker actually came from, and how many rooms, how many collapses, and how many decades it took to build the quiet reflex you carry without ever thinking about it at all.